Welcome to Smith Weekly Discussions, an occasional program for our members of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience of Smith Weekly, including Jeff S., Mark R., Jackie A., Craig S., and Nick W. Returning guest on the program today, Mr. Ryan King is back with us on the program. Ryan is the Senior Vice President Corporate Development of Calibre Mining. The company is a mid-tier gold mining company focused on multiple producing mines, as well as new development projects, underpinned with producing mines in Nicaragua, as well as Nevada, United States, and the development of the Valentine Gold Project in Newfoundland and Labrador, Canada. The company also has a number of exploration projects that it is advancing as well. Calibre Mining is listed on the Toronto Stock Exchange under the symbol CXB, as well as on the US OTC markets under the symbol CXBMF. Ryan, welcome back to the podcast.
Hey, good morning, Andrew. Nice to be back. Thank you.
Yeah, it's good to have you back, Ryan, and to talk here. And why don't we get things kicked off with an update from you on how you're seeing the gold market at this point, and of course, the perspective on where the mid-tier gold producers stand in the mix of the market.
Yeah, of course, it's been a pretty interesting start to the year. Gold currently sitting up about 13, 14% year to date on the back of a strong physical gold price market last year. I think it was about 14, 15% full year. So we are seeing investors in some cases, but mostly central banks starting to significantly load up on gold, physical gold, and we've seen, particularly China, other such countries, purchasing record amounts of gold, and I believe in some cases actually departing with some of their U.S. treasuries. And I think a fundamental shift was basically sanctioning U.S. dollars of Russia, which kind of got a lot of different countries thinking about what could happen with their U.S. reserve currency, and therefore folks may be switching to a gold reserve currency as a safe haven asset. So pretty interesting times here. Obviously, as it pertains to mid-tier gold producers, junior gold producers and senior gold producers were benefiting from that significant increase in gold price, which generally leads to obviously higher margins, higher revenues, higher earnings, and starting to potentially attract not only resource investors, but we're starting to see the early stages of some generalist investors that are looking for some additional alpha. So yeah, pleased to be talking to you in a what looks like a bull market for gold, and I think the future does look pretty bright for gold and gold equities. I mean, we may have some short-term pullbacks and whatnot, but as I was saying on the stage a couple of weeks ago in Germany to a fairly robust crowd, generalist audience, was that if you think about it, gold 24 years ago was trading at about $250 an ounce, right? And now, 24 years later, it's trading at 2,350 about dollars an ounce, US dollars an ounce. That's about an 850% increase. And we all can point to reasons why, but I think significant devaluation of fiat currencies, very likely unpayable government debts, quantitative easing, increasing geopolitical issues, um, and no real indications of any sort of behaviors changing. So I would looking at these numbers and then looking at the future, do we think the behaviors are going to change much as we go forward? It's hard to say that they would. So I would anticipate that this store of value in gold is going to continue, and it may start happening at a more rapid pace. So I think it's a fantastic time for all investors, not just central bankers, to be looking at gold and gold equities as a portion in the portfolio. So I think it's a great time.
Ryan, thank you for that. It brings up a lot of different ideas and thoughts on this, and I think the investor community will continue to latch onto this more heavily, I think, as the price steadies here and even starts to break maybe that 2,500 area. It starts to be off to the races, I think, for some people and provides more of that confirmation or double confirmation in the case of some folks. But I do think it's quite sticky here, given the backdrop of events and the continued devaluation of fiat currencies, as you mentioned. Also, that mining companies have costs, and a lot of those costs are in US dollars and maybe local currencies, if that is applicable, that maybe after costs are handled out there, and potentially there's opportunity for gold companies as well to keep some inventory as they continue to see the appreciation here. And of course, that's supportive from the sense that it starts to absorb some material as well. And then, of course, we have all the other issues that restrict the supply, which is depletion. We have environmental issues. We have all these other things that are happening, political, anti-mining stances, which are laughable. Definitely an interesting time. And of course, separation of jurisdictions, we're seeing more and more. And so there's a lot of factors that are playing into this price. And you and I could probably make an argument that it is still quite low compared to the issues we do have here in front of us. And then, of course, the unknown issues that are coming up yet.
Yeah, no, I agree with you. I mean, just to stay here, right? I think if we have stronger for longer period of time, particularly the longer, right? The longer we can kind of hold this 22, $2,300 price range. And yes, we've seen a pretty significant uptick in a short period of time for various reasons, maybe more so pointing to some geopolitical issues globally. But also, you look at the environment, the macro environment we're in right now. I think there's the Fed. It feels to me like they're probably in a difficult, stuck position. But then, for the retail or family office or institutional investor, I think the number shows globally right now that approximately maybe one or less than 1% of the average portfolio has gold or gold equities in it. Whereas maybe 20 years ago, the average was somewhere between 5 and 10%. So, it's a real quagmire, but understandable at the same time because, gold's had so many false breakouts. And then, gold companies have not been great stewards of capital. So therefore, I think that if we can learn, this industry, if this sector can learn from the sins of the past and really focus on cash flow and real accretive on many metrics, reserve resource per share issued, cash flow opportunities per share. We can focus on that and not just get bigger for bigger sake when the gold price is rising, and be real strong fundamental conservative businesses. Then I think that we're going to start to see a shift into having gold in the portfolio a little bit more readily.
Thank you, Ryan. Good points on that. Well, let's dive right into Calibre Mining. First, it's been a while since our last discussion with the company. Of course, there's been some substantial change over that time, but which I want to get into some of those details in a moment. But why don't you just give the audience a brief overview of the company as it stands today?
I can't remember the last time we were on, but Calibre became a gold producer Q4 2019 by acquiring some assets from B2Gold, really partnering with B2Gold because they became our largest shareholder in Q4 2019 in Nicaragua. We've grown that business year over year through optimization and through a hub and spoke operating strategy that has been very accretive with organic growth, approximately 20 to 30% production growth year over year since acquiring those assets, and really focusing on utilizing the installed processing capacity that we acquired. And on the back of that, we then started to diversify our portfolio. We acquired a company called Fiore Gold in 2021, which has a heap leach asset, a smaller heap leach asset, but a large geologically prospective land package in the Battle Mountain Eureka Trend of Nevada. So giving us an additional about 40 to 45,000 ounces a year production. And then most recently acquiring Marathon Gold, which had the Valentine Gold project, a 5 million ounce, very, very prospective project in Newfoundland, Canada. So we've significantly shifted the company now with that. Well, and I believe this year is a transformational year to become a mid-tier gold producer now. So, Calibre this year, our guidance is 275 to 300,000 ounces at 1275 to 1375 all-in sustaining costs, to over the next few years producing 400 to 500,000 ounces at potentially lower all-in sustaining costs, because Valentine itself, based on a 2022 feasibility study, is expected to produce about 200,000 ounces a year, slightly lower than 200,000 ounces a year on average, at just over $1,000 all-in sustaining costs. So an exciting time for the business, for the company as we transform it. And the focus has been really on delivery and execution, and under promising and over delivering. We'll continue to focus on that. But yeah, I think there's a bright future for the company. I think we've been making some good steps along the way, and in this macro backdrop, we're fortunate enough that we're seeing strong margins in operating cash flow to reinvest back into our business for sustainability.
Good update as to the events since we last spoke. Of course, you've been on the program in the past. Of course, Darren as well has been on the program. Talk just a little bit here, and I want to get into each project area in just a moment, but just overall on guidance, Ryan, can you break up what are the expectations coming out of the current producing mines, just for the audience so we have an understanding of what's coming out of those producing assets?
In Nicaragua, we've actually had some really good success over the last 4 years, being that we have two processing plants separated by about 250 kilometers on paved Pan American highways, so great infrastructure. We had originally anticipated producing 50 to 70,000 ounces a year, and possibly one of the mills heading towards closure. However, Darren, his expertise and his experience as an operator, he looked at the land package, he looked at the capital that had been invested in the plants, the geology, and spent some time talking to communities and government. And we were able to formulate a plan that saw us start to evolve a hub and spoke approach. What I mean by that is the two hubs being the mills, the spokes being different satellite mines, potentially on the mill site concession, or up to 200, 300, 400 kilometers away. And then going through a permitting process to bring these satellites into the operations. And so over the years, we've basically gone from 136,000 ounces in 2020 to this year guiding, I think it's about 235 to 255,000 ounces coming out of those assets, because we have been successful in reinvesting back into drilling and increasing confidence in some of these satellites and current assets. So we've been able to increase our reserves. I think that we've done about 280% in Central America and Nicaragua alone, after producing about 650, 700,000 ounces. So we've got a reserve base of a little over 1.1 million ounces of gold. And importantly, at some of the highest grades these assets have seen, at about 5.1 grams per ton gold. So we've been successful building reserves, and we've been successful growing annual production there too. This year is anticipated to be a record year for us. Last year was a record at 285,000 ounces on a consolidated basis. This year, we would anticipate to do something similar to that, if not slightly higher, given our top end of the range of guidance is higher than last year. So things are going very well there. We continue to build our reputation in country. We've got a very solid social license to operate. We continue to integrate communities into our operations, and we very much appreciate the community connections that we have. That's very critical to our business. It's an important part of how we all do business. And then we look over to Nevada. We've grown reserves in Nevada 50% since acquiring those assets. We've identified a number of fantastic new targets through exploration. We have, I believe this year we're 40 to 45,000 ounces of guidance for production. And then we've got a second asset in Nevada that is only located about 15 kilometers away from our Pan mine, which is the operating heap leach mine. And we continue to advance and work on aspects of that Gold Rock project. And it may have some synergies with Pan. So we're identifying and evaluating that now. So those are the two primary producing assets or jurisdictions that we have in production now. And so that will round out our cash flow in 2024. But then in 2025, in the first half of 2025, we would anticipate starting production at Valentine in Newfoundland.
Right, that's great, and I want to get into that in a moment here. Just want to stop on capital structure for a moment, Ryan. Go ahead and cover off for us the current cash debt position at the company. The company just completed a financing as well. Current shares outstanding, and then of course the major shareholders on the roster.
Yeah, sure. Right now, after that capital raise, we're sitting at about 785 million shares issued and outstanding. We do have some warrants and options mainly to officers and directors of the company. But there's about 54 million warrants that we've taken over as well from, not from the capital raise we just did, but from the Marathon transaction. So they converted on a 0.6164 basis. So therefore their strike price is $2.19 per full warrant. Interestingly, at the beginning of the year, Calibre was trading at about $1.15, $1.16. And I kind of wrote those off because they do expire in September of this year. But here we are a few months into the year, and Calibre trading at $2 Canadian, 19 cents away from those warrants being exercisable. But of course, they do expire in September. So that would be that would potentially bring in, right, almost over $100 million Canadian of cash if those warrants got into the money. On a debt basis, Calibre has taken over the Sprott Resource Lending project finance for Valentine, which was put in place by Marathon Gold, which is a term loan of $225 million. $50 million had been drawn. This is US, so $50 million had been drawn on that facility prior to Calibre taking it over, so $175 million remaining. And we worked through all the details with Sprott on that. That will form part of the financing to complete the Valentine asset construction. About $81 million in equipment leases with Cat Financial. And then Calibre, prior to the deal with Marathon, had approximately $15 million of a small equipment lease loan to a group, a consultant, a contractor we work with in Nicaragua. So on a fully diluted basis, Calibre would have about 890 million shares outstanding. B2Gold represents our largest shareholder at 15%. Board and management about 3% of the company, and recently been acquiring shares in the market. Myself and our senior vice president of growth and strategy, Tom Gallo, have been buying shares in the market. Institutionally, about 45% owned by various family offices and large institutions, 40% retail. So just out of that kind of breakdown of institutions, if you will, our largest, I would call it obviously an institution, ETF, the GDX and GDXJ, owns about 9.4% of Calibre, a little over 75 million shares. All of the large institutions are now significant shareholders. Fidelity, RBC, CIBC, TD, Franklin Templeton, Merck investors, to name a few of the larger funds globally that own Calibre. And then a cash position. Now, this is at the end of 2023. We haven't updated cash yet, but we had $86 million in cash at the end of 2023 after a private placement into Marathon of 30 million US. So that's $86 million US in cash. Shortly here, we'll be coming up with a Q1 update. But subsequent to that last update on cash, of course, we've been spending quite a bit at our assets as well as the Valentine Gold Mine, advancing that through its construction phase. We did do a gold prepay with Asahi in March, which was for $60 million US, and sold forward 8% of the 2024 production. So that brought in 40 million in March and then 20 million in April. And then, as you just mentioned, we just recently completed a Bank of Montreal bought deal financing for originally $100 million Canadian at $1.68 per share. We actually ended up closing the green shoe, giving us 115 million Canadian, and net, I think about 108, 109 million Canadian. So numbers of cash will be updated here in our Q1 financial results, but a fulsome overview there for you on the capital structure, institutional ownership, as well as financial position.
Ryan, thank you for that. I appreciate that. Good information there for got new audience, obviously listening to the first time for this program, so they're getting up to speed here. I'd like to move on here and start with Valentine in Canada. Important project coming down the pipeline here will impact substantially the production profile of this company, the cost profile as well. We're expecting that to improve as well. And obviously where we are with gold price here, things are looking quite good, and quite a bit of cash flow will be coming from these as they get going, and of course existing operations. But why don't you give us an overview of this newly acquired project? Of course, was completed in January of this year. Talk about the project from the standpoint of some of the highlights, the proposed production profile, confirmed permitting status, and of course you talked a little bit of time frame already, but just talk about some of those milestones to potentially get into commercial production sometime in the first half, maybe early second half, as far as commercial ramp up goes of 2025, CapEx requirements, and all those good things you would expect we'd want to hear about.
Absolutely. Very exciting opportunity for Calibre for a number of reasons. We initiated our due diligence middle of last year. We identified this as an opportunity largely because, one, the jurisdiction, but two, largely because it was going to be in production within the next 12 to 24 months. Calibre was looking for producing opportunities, but we could never find the right fit that we saw a significant re-rate for ourselves and shareholders, right? We couldn't get there. So by identifying Marathon, located in Newfoundland, Canada, Tier 1 jurisdiction, and then starting to have the discussions with the group, really saw a fit there because, as you know, last year for junior developers, it was a challenging year. Equity prices were down, even though gold prices were up. So Marathon was running into a situation where they were in need of additional capital to advance the project. And that's where Calibre came along. So fortunately, when we started these discussions, Calibre had had a very good, very clean balance sheet, demonstrated track record from an operational delivery perspective, demonstrated track record of increasing cash position. So the discussions were, well, hey, we can come with, almost $100 million of US of cash, operating cash flow to continue to benefit the build, and a very clean balance sheet. It's a win-win because you also bring this asset from Canada, 5 million ounces in all categories, 2.7 million ounces in reserves. So this is a 3-pit mine plan that will produce approximately 195,000 ounces of gold on average a year for the first 12 of a 14-year reserve life. And I'm cautious about that, and I'm cautious about saying mine life because, reserve life is 2.7, but the M&I resource that falls within the pit design is 4 million ounces. So we believe there's very significant upside from a production perspective as of the information we know now. Okay, so we were fortunate to be able to acquire the company in January of this year. The company paid about US $250 million for all of Marathon, and of course took over the Sprott Resource Lending Project facility of $225 million. So on almost every metric you look at, this was an incredibly creative transaction for Calibre, and we're seeing it. We're seeing it in the market, right? We're seeing the transformation of value go from where we were at the beginning of the year, about $1.15 to $1.20, to now sitting at roughly $2 a share. There has been, increasing confidence because of the acquisition and merger with Marathon, increasing confidence that, hey, this asset is in the right hands. Calibre is already producing 300,000 ounces. And yet, when you put these together, you're going to get a 400,000 to 500,000 ounce a year producer. So what that means is that Calibre is going to be transitioning from a junior gold producer metric or valuation, which is typically lower than a mid-tier and a senior. So let's call it a price to NAV basis of, for a junior would be about 0.4, 0.5, 0.6 versus a mid-tier that trades at anywhere from 0.7 to 1 times in today's market, right? We've seen other gold bull markets where they're trading at 1 to 2 times. So, let's just park that discussion for a minute. However, just on the acquisition and delivery of Valentine, we should see a re-rating of what this means for the overall consolidated company. And then to add to that and to benefit that, it's the diversification piece. So we now go to about 55% of our NAV being in North America, in Nevada and in Newfoundland. So no, it's a great opportunity for the business. We have just recently updated our presentation, and we've announced a number of key milestones already, not just project being construction, scope, schedule, and budget, but also, and this is where Darren Hall, who again, 30 years of operating experience, most of his time with Newmont, comes into bringing his expertise and experience to this business now, is that he has optimized assets around the world. He's built assets around the world. He's managed very large groups of people within his time frame at Newmont. So, his view was, okay, let's go through our due diligence and make sure that there's no major red flags and we can work through any sort of issues that we may come up with. Let's look at, and when we model this, let's go in it from a conservative perspective, being, okay, if Marathon says the capital is $510 million at the end of Q3 of 2023, I think it's safe to say that we should go, 100 to 150 million, if not more, Canadian over that, because, underestimation or, something was missed, or from an operational readiness, something was not included. So let's include that in our models, and let's also look at operating costs being 10 to 15% higher and grade being 10 to 15% lower. Does this still work from our perspective? And of course, the answer became yes. And so, over the last several months now, or I guess I shouldn't say several, but 5 months since 4 months since closing the transaction, we have announced critical path items like the mills and motors for the critical components are delivered to Newfoundland, and actually mills are on site now at Valentine. Power line, Newfoundland hydro power, so very cost-effective green power, 4 cents a kilowatt hour, is now connected to the site and is now electrified most of the site, so off diesel generation. Signing significant contracts. So all of these items are increasing confidence of deliverability. Signing key contracts on steel, mechanical, and piping. Signing contracts and negotiating contracts for electrical and instrumentation. What's great about the asset now is that majority of the earthworks are done, if not almost all the earthworks are done. So foundations and footings done, tailings management facility done, or mostly done. At least the starter dam is in place and signed off by third-party engineers. The mill grinding facility is now completely enclosed. The thickener foundations in place. But then also importantly, and if not as importantly, if not more, is getting the team from a human capital perspective and really beginning to mold out that operational readiness aspect. So you've got your project scope, schedule, and budget, but then you also have to have your operational readiness and your operational team is going to dovetail with that. to ensure that we can identify things now, or risks now, or opportunities now, such that when we are ready to start commissioning the circuit, the wet circuit, and start looking at producing gold, we can be ahead of where we want to be. And so we've just recently announced a pre-commissioning commissioning contract with Reliable Controls Corporation of Salt Lake City, a group that Darren has worked with on one of Australia's largest open pit mines when he was with Newmont Boddington, where they did a great job. So a pre-commissioning team that will come in and customize aspects of the mill if need be. And so therefore we've also dovetailed in with that group a new VP of Operations Canada, Jason Sear, as well as senior mill manager, Andre Morneau. So really starting to build out their team underneath them as well. So a number of key elements to ensuring deliverability are underway. And then, as you just said, kind of updates on official CapEx of where we're standing. We'll anticipate to have something out here this month. I believe the plan is to have something by our May 15th conference call. We'll probably have an update for the Valentine Gold Mine on May 15th, coupled with our Q1 results, and a good opportunity for investors to call in and hear Darren talk about the journey since acquiring the assets and some of the key milestones that we've completed along the way, and of course some that are coming up. So a big milestone will be that, and I think a lot of institutional investors waiting to see what that looks like. And then, we'll have a full camp this summer, so a lot of progression through this summer. Would anticipate that real wet circuit commissioning starts up at the end of this year, and would anticipate first gold by Q2. Consistently say H1, but I realistically think we're going to be Q2 of 2025. And then, as you say, ramping up to commercial production likely by middle of the year or second half.
Looks like everything is moving along confidently, without issue, and looking forward to seeing this go forward. And doesn't look like a lot of complications, so I think it's fairly simple and straightforward. And excited to see this get into the production and get added to the portfolio here.
Well, not to diminish it, but you've seen, and we've all seen, and this is why there's such a heightened focus on this, right? Sorry to interrupt you, but it's important for Darren, for myself, for the whole team, that all the very specific detail on this is done properly and done above expectations, because unfortunately, we've seen a number of companies hit walls or have issues or significant overruns that they cannot finance. So it's really important for this team to deliver on this expectation, because we have built up a level of credibility and trust given what Darren has done over the last 4 years. So we do not want to disappoint. We're very focused on this. And it doesn't come without risks. Building Atlantic Canada's largest open pit mine, it doesn't come without risks, but we are trying to do everything we can to mitigate those risks. And I think Darren does a fantastic job with the team he's got in place and the advisors that he has around him, people that he's brought in, that he worked with at Newmont, that will be very helpful in identifying challenges and finding solutions so that we can be proactive versus reactive.
Right, and I can appreciate that completely. I mean, it makes sense to have extreme good planning well in advance. We got the issues with lead times. We've got all the issues surrounding making sure we have staffing and competent people, which obviously you guys have been able to demonstrate to keep and maintain competent staff at Calibre Mining, which I think is an important piece, because human resources across the entire natural resource sector is starved, not to mention other industries as well. And so it's always good to see competent people around here, and very excited to see this go forward. And I know you guys can draw upon quite a experience pool to bring this forward. And I think it demonstrates further for the company the ability to, not only do acquisitions and take over existing facilities and improve them, as you guys have demonstrated with other assets, but then to also build out something of this size and scale as well. Just before we move on with Valentine, talk just a little bit more about how you guys see the expansion potential Besides what's already identified, obviously there is the potential to extend mine life, but also just the exploration potential there to continue adding to this project once you guys get into commercial production.
Well, I'm glad you asked, Andrew. To be honest with you, this is probably, I mean, for all resource companies, finding new is highly critical, but also very exciting. And I think that, obviously biased here, basing my biased emotion on information that I've gathered now from numerous geologists at Marathon, numerous geologists at Calibre, third-party geologists that aren't related. Franco-Nevada has a royalty on the property and their geological and corp dev team. I'm basing my information on our lead director, Doug Forrester, who has discovered numerous deposits around the world, sold numerous companies. And so, yes, I have a bias, but I also am pragmatic and logical about looking at things. And it's hard to do that when you're talking about gold and discovery and resource expansion. But Valentine presents a very, very compelling opportunity for discovery of new ore shoots, of expansion of existing resources and reserves. Just to kind of lay out the timeline here a little bit, I believe it was probably 2012, 2013 when the previous founders of Marathon started to go and look at the Valentine Shear. The Valentine Shear is the primary kind of host, if you will, or fault that goes through the property that's about 32 kilometers long. So Valentine is an orogenic gold deposit. There's, very similar orogenic gold deposits in geology around the world, but just to give you an example, the Porcupine-Destor Fault, Timmins, which has tens of millions of ounces, the in Val-d'Or, for example, particularly similar geology and mineralogy is Sigma-Lamaque with, multi-millions of ounces owned now by Eldorado and a very low-cost mine for them. So you look at the comparisons and you look at Valentine today and you go back to, okay, one of the deposits, one of the open pits was discovered in 2013-14. And then a geologist that's still working on the property now discovered Marathon, the Marathon pit. So you've got the Leprechaun pit, the Marathon pit, which was discovered, I think Marathon was discovered 3-4 years later. And then in 2020, the Berry pit in between the two areas was discovered. This is why part of the reason why I'm so excited about it is because you look at the evolution of the discovery of the three pits now. We're very young or early in the discovery process here. The amount of exploration work that's been done across the 32 kilometers is very minimal. Resources is only over 6 kilometers of the whole 32 kilometer Valentine shear zone. And then there's another whole parallel shear zone we call the Northeast Shear Zone that has no drilling on it at all, and has very little, or sorry, the Northwest Zone, and has very little exploration done on the whole property. And so what also gives me levels of excitement is that we recently finished some ore control drilling or RC grade control drilling at the Leprechaun pit. This is only a few benches in, and these are RC holes that are spaced about 9 meters by 9 meters. And what the team identified was some new additional ore tons, additional ounces, and a new high grade area to the southwest. So this new high grade area within the pit, right? So within the pit, discovered 46 grams over 5 meters, which was not modeled, 17 grams over 7 meters. So a number of good hits like that, although still very shallow, only 20 meters from surface. So it does also lend itself to, okay, what else could be there in an area that has limited drilling to the southwest edge of that pit? And actually, there's an area there that is becoming one of the highest priority targets for the team because of this new high grade lens and because of no drilling from the edge of the Leprechaun pit through to the next zone that was identified called Frank, where we've had a number of early stage drill intercepts that looks like it could be another pit. About 1 kilometer separates that. And so, when we take a big step back, these types of deposits can go very deep. They can be numerous along these types of shears. And the group has found what we call quartz tourmaline pyrite. That's the host rock where Marathon Berry and Leprechaun have all the gold. We've found that QTP in soil, in rock, in float samples, in outcrop on various parts across the whole property, down to the west and southwest in our western peninsula target, all the way up to the north in our eastern arm target. So there's numerous targets that have not been drilled, have not been followed up on, and because Marathon had been so focused on advancing through economic studies of what they currently knew, going through permitting of what they currently knew, and really not having the opportunity and or the dollars to invest in exploration at some of these other targets. And so very excited because this year we're doing 10 to 15,000 meters of diamond drilling, but we're also doing, I think it's about 20,000 meters of RAB drilling. RAB and what we call winky drilling, which goes through sort of surface till until you get to bedrock. And it's that QTP in the bedrock that we're trying to identify and target and then follow up in 2025 with a much larger, hopefully, much larger diamond drill program across this property. And you talk to different institutional sales or research analysts or institutional investors in the space that are familiar with this asset. That's what they've wanted to see is significant drill programs here because it's still early days at Valentine.
Good information once again, and I encourage the audience to spend a little bit more time on some of the production parameters and some of the other work that's been done, the testing work and so forth on this project as it goes, but then the expansion potential as well there. I think that that's a key highlight here as to why you guys pick this asset up and the valuation you see, even post M&A transaction, and what kind of cash flow this can throw off, and of course life of mine and NPV parameters and all that good stuff. So I appreciate that. With respect to Pan, and you talked about this before, the Pan mine is in Nevada, United States. And you alluded to obviously the potential there to continue operations and also attach satellite operations to that project. With that, talk about the potential there also to build U.S. operations further, maybe specifically in good jurisdictions like Nevada, which obviously you're already in, Utah, Idaho. What is the future for the United States as a jurisdiction for Calibre Mining?
Yeah, it's a great question because in the acquisition of Fiore Gold, it wasn't just Nevada, but it was also a 2 million ounce measured and indicated resource up in Washington. So now we'll park that for just a second, but that came with the acquisition of Fiore. And to be honest with you, presents a pretty compelling opportunity, albeit it's in Washington, so permitting can take some time. But just to park that for a second, going back to Nevada, I mean, Nevada being a tier one, and as per the Fraser Institute, one of, if not the number one jurisdiction for gold mining. And let's talk about why. I think the number one reason is excellent geology. Very, very large deposits have been discovered there. And as many would say, a strong mining legislation or rule of law. Now, Nevada has all of those great characteristics, but it also has challenges that come with that, right? They've got challenges being, to get a greenfields mine permitted can take, well, I think probably between 5 and 15 years. And I think 5 would be quite a challenge. So a greenfields mine in Nevada would take quite a while. You've got a lot of work to do from an environmental perspective and all the aspects of permitting a mine. You have more bureaucratical processes to go through than you say maybe 20, 30 years ago, 10, 20, 30 years ago. And they continue to add to regulations, which is fine. Human capital in Nevada is stretched, right? You've got some challenges there from a labor cost perspective, from a finding quality, really good quality people to run operations perspective, and it's very competitive, incredibly competitive. And unfortunately, some of the areas in Nevada are not towns or cities or communities that are super attractive for some, and some there is. So you've got some challenges there. So you've got pros and cons. And that being said, so Calibre not only acquired the Pan operating mine, but 222 square kilometers around it. For us, again, it's not a huge asset in the portfolio, but it does 40 to 45,000 ounces a year at $2,300 gold, has some great margins. We continue to invest in the exploration upside. As I've mentioned, I think we've increased reserves 50% since acquiring the asset in 2020, closing it in 2022. And then we've got this second asset called Gold Rock, which is federally permitted, fortunately. We are just finalizing the water and air permits for that, if not already got those in place. And this is, again, a small 400,000 or 500,000 ounce resource, lends itself to be a heap leach operation. Previous owner had said that, it could produce 40 to 50,000 ounces a year. Probably capital cost to put that into production would be somewhere between 80 and $120 million. And so for us, I don't think that would be a great use of capital, given what we have going on right now. So the company has been investing and looking at the opportunity to maybe see if there's synergies between Gold Rock and Pan, given that Gold Rock is located by road only about 15 kilometers away and is at surface and is probably double the grade of Pan. So maybe there's some synergies between the two. And again, we've got a solid team in place there at Pan. Kevin Riley's the general manager there and does a fantastic job of running that operation. It is a lower grade. It's about 0.4, 0.38 grams per ton heap leach. And he does a fantastic job of real cost control to ensure that we have decent margins and it can generate some cash to reinvest back into the exploration. So yeah, we're looking at these types of opportunities in Nevada, but then come back to Washington where we've got that 2 million ounce M&I resource. We did some drilling last year and we got some great results. We're continuously doing some evaluations on that project from a metallurgy perspective. But what's interesting there is that Kinross has a mill in that area that is on care and maintenance and has been for a few years. However, it would not need, to my understanding, it would not need any significant additional permits to recommission the operation. And I understand that they've had a new discovery at their mine located about 10 kilometers from the mill. I believe it's called Buckhorn. So I understand that they've had a new discovery there. They've been investing in the asset there. And maybe, I can't speak for Kinross, but sort of hearing that maybe there's an opportunity that could form some of their project pipeline in the future or look at recommissioning the area there. And that could be interesting for Calibre, given that we've got the largest resource in the neighborhood. We're located about 10 to 15 kilometers away from the Kettle River Mill. I believe, without going into too much technical detail, that there's probably some synergies there from how this could be processed in that mill perspective. So yeah, no, I don't know what that looks like in the future, but it could become a quality asset in the portfolio that I think, when you look at it, when we originally did this deal, probably had a very low valuation for it. So don't know what that looks like yet, but 2 million ounces in the United States, surrounded by infrastructure and companies that may do and may advance something back into production, could definitely be of value.
Yeah, I think that's good as well to see that work on United States jurisdiction and how that can also play into the overall strategy for the company. And then, of course, some opportunities in the future, which I'll come back to in just a moment, Ryan. Why don't we move south here a little bit further to Central America, talk a little bit about Nicaragua, El Demon, La Libertad, the Pavon operations. Talk about things in Nicaragua as far as those operations go. I know that they're substantial operations for Nicaragua, very important for the country's economics. How are things going there, and any potential plans there to continue expansion work? And you guys, of course, have exploration grounds there as well.
Yeah, and to your point, it's important to us. I think it's important to the economy. I think it's important, particularly for all of our host communities. And that's really critical to us because we really try to focus on hiring locally and demonstrating that commitment to economic diversification within those communities in which we operate. And I think the latest stats are pretty significant. Hiring locally represents probably 70 to 75%, if not more, of our employees come from those local communities. So Limon, let's just start there. Limon is a smaller milling operation, so about 500,000 tons a year of rock will get milled, and that mill gets used at 100% capacity. Surrounding the Limon mill, we have a number of different mines. So we've got the open pit mines, the Limon open pit mines. There's about 2 or 3 open pits that are currently along what we call this kind of string of pearls that is located only about 200, 300 meters away from the mill. We've got the Santa Pancha underground mine. We have the Panteon underground mine. And then we've got the Atravesada underground mine there that are all feeding into Limon. But also, excess material gets put in a 25-ton haul truck and driven over the Pan American Highway, good paved highways, over to the Libertad facility that is a 2.2 million ton per annum facility. And we currently use about 1.5 million tons of that capacity or less. I think the latest stat is we've got about 1 million tons of additional capacity in Libertad. So it does present an organic, very low cost organic production growth opportunity. And as I mentioned, we started that in 2020. So we started to haul material from Limon to Libertad responsibly. And over the years, we've added to that responsibility by ensuring that drivers have training, education, that all these vehicles on the road have cameras in the front and the back. They have GPS units. They have governors. There's fatigue management programs in place. Logistics center in Managua, and so it's really, really important to us that all of those necessary measures happens. This is very similar to many companies around the world, would haul and transport their goods around the world, like Amazon. This is Amazon in reverse. It's taking from the house back to the warehouse, or the end buyer back to the warehouse in the case of Limon, Pavon, and Eastern Borosi. So no, it works quite well for us, and we ensure that we do this very responsibly and transparently with the government, the communities that we work in. Yeah, to your point, Pavon, a satellite deposit located about 300 kilometers away from the Libertad facility. These are all low sulfidation veins. So when I say that, what it means is that they're all amenable to being processed in the Libertad facility. So we get about 90% recoveries when we blend the material, and it works very well for us because that's the main mineralogy that we're mining and processing. Pavon it's a 3-pit satellite spoke. We've mined Pavon Norte, Pavon Central, and then we'll be looking to Pavon South in the future. And so from each one of these areas, we're hauling about 1,000 tons a day. Average is anywhere from 1.5 to 3.5 grams from Limon. Average is about 3 to 5 grams per ton from Pavon. And then last year we finished permitting the satellite Eastern Borosi, which is located about 400 kilometers away. However, the country just put in a new paved highway that goes from the Atlantic side all the way down to the Pacific side. So we utilize that highway, and we didn't pay to put it in place. This opens up that jurisdiction for us and allows us to mine, add jobs, mine, and bring that material down to the Libertad facility for processing. So this year we're mining and processing probably an average of 5 to 7 grams per ton from Eastern Borosi. And of course, by doing all of this, it allows us to then generate very good margins. I think we're $1,100-$1,200 all-in sustaining cost, or maybe this year we're $1,200 to $1,300 all-in sustaining cost in Nicaragua, generating good margins, putting money back to work into the system. I think between employees and contractor, Caliber has roughly 3 to 5,000. I know that's a big spread, but I don't know exact numbers, but a significant number of employment. And I believe the number is 94% or higher is from directly employees and contractors are directly from the country in which we operate there in Nicaragua. It's been a journey. Obviously, there's been ups and downs along the way, and yet I think this is benefiting Caliber. This is benefiting communities. This is benefiting the country, and it's a very small country, 6 million people, less than 10 billion GDP. And we just want to continue to build our reputation, do the right thing, be transparent. And I think there's additional opportunities. I mean, as you mentioned, numerous mineral concessions around the country. So the opportunity for Caliber now is one that, hey, we can look at a greenfields exploration project 100, 200, 300 kilometers away from our existing facilities, knowing that we've gone through the permitting process. We know what it takes. We know what is required. We know we're going to be very, following all international codes of conduct about how we go about doing things, and being very transparent with our local communities. We've got a demonstrated track record now of doing that and a strong reputation and social license to operate. So, and yet we still have 1 million tons of surplus capacity. So very excited about that potential. And I think we're getting close to almost 100,000 meters underway in Nicaragua this year. We've got 12 rigs operating there now. So it's presenting itself as, a cornerstone and an opportunity for growth.
Ryan, thank you for that. And it's good to point that piece out, and also just the overall importance to the local community and the economy there in Nicaragua. What you guys are providing there provides stable jobs, it provides economic activity, indirect jobs, and it's very important in that sense. Of course, with some of the other challenges that Nicaragua is having and other countries that are essentially picking on Nicaragua, I think that this is a beacon of light there with respect to keeping the community engaged, keeping economic activity happening, despite some of the other challenges on the economy front. So appreciate that. Appreciate your guys' efforts there. I just want to cover off as well. Of course, you guys have been active on mergers and acquisitions, as we've highlighted already in the discussion and over the recent years. And given market conditions even today, Ryan, in the junior sector specifically, as you well know, there's a number of companies that remain to be quite suppressed as far as valuation goes, and there's opportunities still out there despite the gold price. I'm assuming the company will remain active on the M&A front, but also now that we've moved into Central America, I guess it's a good time to maybe talk about the specific jurisdictions, if you can share a few with us, that would be maybe priority as the company continues to go down the pathway of building pipeline and building value, and of course, growing this company.
Yeah, great question. Obviously, we've been doing some of that over the last few years, and so it makes sense to take a look. Um, this transaction that we've just done is very significant, very important to us and to the province, and communities in Newfoundland. It's one that I believe, and we all believe, that upon very successful delivery of doing what we said we were going to do, and in light of complete transparency, that we would be very focused on this. And so Caliber is very focused on delivering this new mine, because we have not demonstrated that yet in our journey. We have demonstrated acquiring production. We've demonstrated optimizing production, but this is an opportunity where we can now demonstrate picking up where somebody else left off, advancing it through, financing it, delivering construction, and then production. So our focus is on Valentine and our current operations as of right now. And because the re-rating, I think, is quite real, from a junior to a mid-tier, a diversified portfolio like this. It really opens up the door for a lot of additional institutional investors feeling comfortable about this team, this asset portfolio, in general. So for the short term, for the near term, That's our focus. In the future, upon delivery and upon getting that, hopefully, getting that re-rate that we believe that should come with 400 to 500,000 ounces a year with this kind of portfolio. Just on that, you look at some of our peer group that does 400 to 500,000 ounces, and Calibre is at the bottom of the market cap valuation, is at the bottom of the enterprise value per ounce valuation. So we have to demonstrate that we can deliver this, and once we do, I think that's demonstrates that, hey, there's a chance for us to re-rate to much higher market caps and valuations. And then, yes, of course, we would look at maybe the current jurisdictions we operate in. We would look at possibly something new to unlock additional value for our shareholders, as long as everything that, or anything that we do, is going to be accretive. We have to make sure that everything we do is accretive on a per share issuance metric. Otherwise, again, we look at what we've talked about, the destruction of value in this space. We just have to absolutely be clear that whatever we do is going to be accretive metric. And yeah, I mean, there are a number of developers out there that may not be as close as Marathon was to production, but are still quite advanced and could present compelling opportunities. Some of these developers are trading at lower rates than we've seen in many years. However, I think mid-tiers, juniors, and seniors are going to be patient about and do significant levels of due diligence to ensure that they will not disappoint their shareholders, and they will be stewards of capital to ensure that we can attract and keep investors for the long run.
And just with that, is the company open to, globally, or is it only focused on the Americas? Any particular geographic area you'd like to look at, or is everything pretty much on the table based on good value?
Pretty close to everything is on the table. Yeah, as you say, as long as it has good value and good geology, right? Valentine had good value and has incredible geology. I mean, and at the same time, I think, I can't speak for the board, but I think at the same time, as we deliver Valentine, I think that the company would probably be open to looking at big opportunities as well, mergers, acquisitions, and other acquisitions being ourselves taking out others. So we keep a very open mind. You have to keep a very open mind to be able to pivot in this marketplace environment. And I think this team is agile and entrepreneurial, but with a very keen focus on share price performance and adding value to shareholders, like we did on our last company with Newmarket, the discovery of a high-grade gold deposit, and then merging the company with Kirkland Lake that went on to a multi-billion-dollar company and did very well for shareholders. And the key there is we just saw an opportunity to diversify and then step out of the way to ensure that an accretive deal could be done. And maybe that's the future, maybe it isn't, but we're always trying to look at ways, be open-minded, be able to pivot, and create value on a share price performance basis, because that is our product.
Very good points there, Ryan. Well said. I appreciate that. Well, Ryan, why don't we finish up here? I really appreciate the update, and why don't we leave it there for now? But I'll leave you with this question. For potential investors who are listening in, the company has a market capitalization of about 1.6 billion Canadian dollars. Why should Calibre Mining be considered within the institutional, family office, and retail investors portfolio at this stage?
Well, for most of the reasons I've said throughout the discussion here today, if you believe that we're in a bull market or even a flat market for gold, if you believe that, then companies are going to do everything they can, including Calibre, to maximize margins, to maximize earnings, to create shareholder value, and not do silly things to destruct value. Right now, Calibre is laser focused on delivering Valentine, which will transform us into a mid-tier gold producer. Yes, we have to complete the construction of Atlantic Canada's largest open pit gold mine, but we have the team, we have the resources, we have the finances to do that. And I think that will unlock a lot of value, which then transforms into the potential for much larger ounces and discovery. Those, to me, when we look at companies like ourselves today or any sort of resource company, in my mind, the largest value that can be created for shareholders is discovering new minerals, discovering new resources, expanding resources. And I think we have a tremendous opportunity in all the jurisdictions. But, if I were to rank and rate right now, I would say Valentine really does host the greatest opportunity, near-term opportunity for Calibre, given what we've recently seen in some of the high-grade drill results. So, no, I think it's compelling. And I think the longer we stay at this gold price, yes, most boats will rise, but those that deliver and those that complete and beat what they said they're going to do, like Calibre has done over the last 4 years, will outperform peers.
Yes, absolutely. Definitely company specific driven events and success is obviously key in an overall better cycle or upswing, if you will, in the gold price. So I appreciate that. Ryan, best way for interested parties to reach out to the company?
Well, thanks, Andrew. That's probably going to be me. Obviously, visiting our website is a predominant mode of communication. Calibre Mining, that's CALIBRE mining.com. You can find my information there on the website. You can get in touch with me directly via the website, or my email rking@calibremining.com. And by all means, please reach out. I'm very open to discussion, criticism if required, good constructive dialogue. We're always looking for opportunities to add value and always looking to hear from our shareholders and potential investors. So that's likely the best route.
Ryan, thank you for taking the time to give us an update on work at Calibre Mining. Best of luck on all the initiatives at the company and construction. We'll talk again soon.
Excellent, Andrew. Look forward to it. Fantastic podcast as always, and I really look forward to an update as we advance Valentine.